Hi, I'm Ed Pound, the Managing Director of the Operations Science Institute. Welcome to the Institute's series, 52 Weeks of Operations Science in 2 minutes. To be clear, we're not going to compress a year's worth of operations science into 2 minutes. Every week during this 52-week series, we will provide 2 minutes of powerful, practical operations science insights. If you are not already applying operations science, you're wasting money and resources. Supercharge your and your team's skills with high-value, low-cost operations science online certification. Welcome. This week we have part 1 of the dynamics of managing an inventory buffer, which will lead us eventually to financial recommendations and implications for inventory management. In the fundamental operations science framework, the topic is the inventory portion of the buffer portfolio. From an operations science perspective, there are 2 types of inventory due to the nature of their most basic function. To understand these 2 types of inventory, we return to our basic definition of an operation. We have process centers, which are capacity resources, could be a person or a machine. There are also queues where work often is waiting. The first type of inventory is work in process inventory. Work in process, or WIP, is unique because it is required for transformation to occur. If you have 0 WIP inventory, you have 0 throughput and consequently 0 revenue, which makes for a really bad business model. WIP inventory can be for any type of demand. Make-to-order pipe spools for a construction project, services such as treatments at a hospital or diagnostic lab testing or repair and overhaul. WIP could be tasks required for project completion. WIP could also be physical items that can be stocked to satisfy demand. Those physical items at the end of a transformation flow make up our second type of inventory, stock inventory. If there was 0 variability and perfect synchronization of demand with transformation, there would be no need for stock inventory. A product would be provided exactly when demand appears. Stock inventory exists because fundamentally the real world is full of variability. Demand and transformation never perfectly synchronize. Stock inventory such as cars, sugar, or drilling pipe is produced in anticipation of demand. We will cover the dynamics of stock inventory in part 2 of our inventory discussion. A primary operations science relationship governing WIP inventory is Little's Law. Little's Law states that cycle time equal WIP divided by throughput. Cycle time is the dependent variable. You must first have capacity and then WIP to know what your cycle time is. The other 2 algebraic forms of Little's Law are also useful. However, be careful. Little's Law says nothing about variability. Operations science provides powerful and practical flow performance curves so that people from finance and operations can account for variability and don't have to guess on investments in capacity assets and WIP working capital and what cycle time to expect. I have seen operations crippled with too little inventory pursuing one-piece flow and operations crippled with too much inventory pursuing unit cost and financial variance targets. Forewarned is forearmed. Next week, we look at the fundamentals governing stock inventory. Please join us at the Operations Science Institute. Like, share, subscribe, and comment on this video. Create an account at opscience.org for more great resources. Both the account and the resources are free. Contact us at info@opscience.org for personalized training. The Institute will train and certify your own trainers for long-term sustainability in your organization. Get your own Operations Science online certification. Share your knowledge and inspire, energize, and sustain success for you and those around you.